You know, for the last 2 years, all anyone on Wall Street seems to want to talk about is the EV price war. But it turns out there's a leaked internal report from Tesla that tells a completely different story, one that, frankly, the market has just been completely missing.
Yeah, that's the whole thesis in a nutshell, isn't it? This report basically argues that there's been this fundamental misunderstanding of Tesla's entire business. Everybody's been watching the wrong show.
Exactly. And look, this isn't just us guessing. Our entire analysis today is based on this leaked internal report, and it's literally titled The Great Decoupling. The whole argument is that Tesla's energy division has just structurally broken away from the car business, and if that's true, it completely upends how you value this company.
So this brings us to the first really big reveal from the report. The data shows this clear decoupling. I mean, while the auto business is getting hammered by price wars, the energy side of the house is quietly turning into an absolute profit machine.
Okay, so let's just set the scene here. This is the number that everyone knows and talks about, right? Automotive gross margins. They're hovering around, what, 17, maybe 18%? And that just shows you how brutal that global EV price war has become. It's a tough, tough business.
But then, you see this. In that same period, Tesla Energy's gross margin was 31.4%. I mean, that is nearly double the margin of the car business. It's an absolutely stunning figure that, for whatever reason, nobody is talking about.
And this chart just lays it all out, doesn't it? This isn't some one-time fluke. The data from the third quarter of 2025 shows a real structural divergence. This is the moment these two businesses went their separate ways, financially speaking. Energy is just a fundamentally more profitable business, period. Right, and we have to be super clear here. This isn't some small, high-margin side hustle. We are talking about $3.41 billion in revenue in a single quarter. The scale here is massive. This division is essentially a Fortune 500 energy company that's just operating inside an automotive brand.
So here's the strategic kicker. The report actually calls the energy business the new margin buffer for the whole company. Basically, Tesla is taking all this cash from its super profitable battery business and using it to fund those moonshot, capital-intensive projects in AI and robotics. You know, batteries are funding the robots.
Right. Okay, so we've got the what. We know what's happening on the financial side. The next obvious question is how. And that gets us into this really fascinating strategic and tech battle that's being fought over the future of the grid. Okay, hold on. I have to play devil's advocate for a second. The numbers look great, but are they really winning the technology race here? I mean, their biggest rival, BYD in China, just launched their MC Cube system. It uses that super dense blade battery, and they're making some pretty bold claims about being technically superior.
It's a great question, Ben, because it gets right to the heart of two totally different philosophies. BYD is all in on density. How much energy can we pack into the smallest possible footprint? But Tesla's new Megablock strategy is playing a different game entirely. They're competing on speed. They're not trying to win the war at the battery cell level. They're trying to win the war on deployment velocity.
And this is the really clever part. The Megablock is a pre-integrated system. So think of it like a giant Lego block. It's got 4 megapacks, a transformer, all the switchgear, all packaged together. The report is claiming this cuts install time by 23% and slashes construction costs by up to 40%. They're not attacking the battery. They're attacking the real bottleneck on these huge projects, which is the construction site itself.
So, you've got this hidden profit engine, this really clever grid-scale strategy, but there is a massive storm cloud on the horizon. A huge regulatory change is about to hit the US market, and frankly, it's creating a really urgent situation.
That's right. The legislation is called the One Big Beautiful Bill Act, or OBBBA. You can't make this stuff up. The key thing here is that it completely kills the 30% federal tax credit for residential solar and battery storage. And the hard deadline is December 31st, 2025. It's just weeks away now.
And you can see the effect perfectly on this timeline. The second the bill got signed, it kicked off what the report calls a gold rush. Every homeowner, every installer is scrambling to get systems in the ground before that credit disappears. So it's pulling a ton of future demand into this current quarter, but it's setting up what could be a demand vacuum, a huge cliff, come January.
But, and this is a really important but, the OBBBA cliff only hits the residential Powerwall business. The tax credits for the big utility-scale projects, the megapack business, those are actually kept in place. So that insulates their most profitable business segment from this shock, and it just reinforces that strategic pivot to grid scale.
Okay, so that really sets the stage for 2026, which is shaping up to be the real test. Let's wrap this up by looking at the key signals that anyone following this space needs to be watching in the next few months, right after we go over this cliff.
First up, we're all going to be watching for that post-OBBBA hangover in residential sales. And we'll be looking for the first Megablock pilot deployments to see if the real-world performance actually matches the hype. We're also tracking any new tariffs on Chinese battery cells. And this is a big one. Can BYD finally land a major project in a Western market? That would be a huge signal about their bankability with the big project financiers.
Which really leaves us with the final, pretty provocative question that this whole analysis brings up. After you see the margins, the revenue, the strategy, is it time we stop thinking of Tesla as a car company and maybe we should start seeing it as an energy infrastructure company that just happens to sell cars? I mean, based on this data, that really seems to be the story.